In 2012, a hippie friend of mine said, I just bought some ganja on the Silk Road in Bitcoin. Right. And this Bitcoin thing's amazing. And he was a gold bug. And he said, well, this Bitcoin's got limited supply. And I said, don't be stupid. You can't have money on the internet because you can cut and paste it. Why do Bitcoin and gold have this extraordinary relationship? And that's really, really simple. And that's because they have extraordinarily low correlation. I'm not remotely surprised that internet money and internet stocks are correlated.
Charlie Morris is an investor, entrepreneur, and advocate for hard assets. He has 27 years of experience in fund management, with a reputation for actively managing multi-asset portfolios. Charlie was previously the head of absolute return at HSBC Global Asset Management, where he managed $3 billion worth of assets. He writes research for private clients, providing actionable model portfolios that cover equities, bonds, commodities, and other alternative assets. Having discovered gold in the early 2000s, Charlie was an early entrant into the Bitcoin rabbit hole, and in 2013, he founded ByteTree, which he initially intended to be the Bloomberg for Bitcoin. However, he was unable to find a workable revenue model. Often with startups, being early is just another way of being wrong. However, in 2022, he launched a Bitcoin and gold ETF called Bold, a fund that remains unauthorised in the UK, albeit available to sophisticated investors in other European exchanges. As Charlie says, he developed Bold as a new take on the traditional 60-40 wealth portfolio. He identified a valuable low level of correlation between its constituents, the Bitcoin price and the gold price, which he has exploited to deliver impressive results. Towards the end of this chat, we trade thoughts on the latest UK microcap craze for Bitcoin treasury management companies, which Charlie sees as unsustainable and just the result of regulatory arbitrage. Before we get going, here's the bit where I tell you that none of what you're about to hear is investment or any other kind of advice, but just for your information and hopefully entertainment. You should take personal financial advice before investing a penny of your money in these crazy markets. With that, please enjoy my conversation with the maverick, Charlie Morris.
Brought to you by Progressive Equity.
Charlie, thanks for joining us today. Can we just kick off with you telling us a bit about your background? How did you get into investing and financial markets?
Well, it's a pleasure to be here, Jeremy. I guess it started, I flipped a couple of IPOs whilst I was a student. I read the books, Jim Slater's Zulu Principle and many, many others. I then joined the army and I was very active in the stock market, describing the Investors Chronicle and that sort of thing. And left the army and joined James Capel in 98. James Capel, of course, was renamed HSBC in the late 90s. And I was in the investment management department. And about 2002, the Chinese clients, the Hong Kong Chinese clients, were sort of screaming, saying, why is everything going down? And so they sort of screamed for, why don't you sell things when they're going down? And the answer was benchmarking. People said, well, you've got the global index benchmark and we've got to have this much in that country and that much sector and that sort of thing. And of course, it was active management, but with quite low tracking, with low active share, I think you'd say. And my then boss, who became my boss, said, let's launch an absolute return service. And Charlie, that young kid, seems to be interested in technicals and charts and weird things. He keeps talking about gold. So I was brought in to be part of the team and ended up becoming head of the team. And by 2008, we were $3 billion and we had this fantastic diversified portfolio. Let's just call it, roughly speaking, a third fixed income, a third stocks, and the rest in commodities and alternative assets, something like that. And we moved around a bit. So we had all these different things. We had a very low volatility portfolio, 4.5% vol over the period with a sort of 10.5 returns. And so unsurprisingly, everyone loved us. Then after the credit crisis, which we went down 15% that year, which wasn't too bad, although I look back and wish it was zero. I mean, no one really made money apart from a couple of the big short sellers, but then they went on to lose money afterwards. So, there weren't many people that really pulled off that trick. And it was historically an odd one, to say the least. And so, the world's been printing money since then, hasn't it? to make sure it doesn't happen again. And, after 2008, the bank sort of went towards passive management, and people like me, these sort of active managers, were considered high-risk dinosaurs, even though our portfolios were lower risk than the mainstream ones. I'm not bitter or anything like that. It just, things changed.
Tell us about ByteTree. What's the idea behind it? What's the problem that you're trying to solve for people?
So in 2013, I was intrigued by Bitcoin and set up a little research project, found a coder, who was a friend of mine's son, and we basically tried to build a sort of Bloomberg for Bitcoin. I was desperate to know what the hell the blockchain was telling us. What was the information in it? So was there more transactions? How much money was crossing the blockchain? Was it economic? Was it a magic bean, or was it something serious? And the research did tell us very clearly that it was something serious, and we had a good product, but there were very few customers. So that business did fail. So ByteTree morphed. I think we called time on it a few years ago and said, no one really cares. And there were so many free things on the internet, but people doing bits here and bits there. There was no proper business model in what I had envisaged originally. And so ByteTree morphed into a research business, basically. And so I'm doing what I did at HSBC today, but on ByteTree, my clients get research on stocks and bonds and commodities. For example, this year, the portfolio to date this year is up 18.2% in GBP. So the whiskey portfolio, which most people say is quite good. It's not always that good, but this year we seem to have it pretty right. We also have a sort of balanced portfolio. We do crypto research. We have a global trends thing called what's called Global Trends, where we study 3,000 equities and every Monday morning put out a free report on what's happening here, there, and everywhere. So, we're very active and busy, and we cover gold as well. And the final piece, our night job. So day job, we work hard doing research, but our night job is a Bitcoin and gold ETF, which is in Switzerland, which we managed to launch 3.5 years ago after a 2.5-year regulatory delay.
What took you to the rabbit hole, and how far down the rabbit hole did you get where you had this light bulb moment where you said, yeah, this is not a Ponzi scheme, this is for real?
I joined in April 98 at James Capel, and I had a friend who called me, had been in the city for many years, a sort of distant relative, and he said, Charlie, this is perfect. It doesn't get better than this. All the numbers are great. Unemployment's down. Inflation's down. This is what they call Goldilocks. This is amazing. And the market peaked that day. And April 98, then we had the Asia crisis, and they wouldn't go and make a new high for another year or so. And that sort of really woke me up to markets.
Lesson in psychology, isn't it, really?
Absolutely. And then about a year later or so, I was invited to a presentation on gold. I don't know how that came about, but it was Tocqueville Asset Management, Canadian firm. And, a very elderly gentleman gave a presentation, which I just found compelling, about how gold was just basically irrelevant and the price was so low. But it wasn't irrelevant. It shouldn't be, and it won't be in the future. And this is the buying opportunity of a lifetime. And of course, gold was $250 at the time, or around that.
Around the selling price, I think.
Well, it had just been selling, and that was uncovered. And I just started to observe the gold price. And then I observed the 200-day moving average turning from negative to positive during the dot-com, noticing how the gold stocks were proving resilient, looking for things going the other way. We started to build spreadsheets and models and things, identifying what things were doing. And you started to see all the relative highs coming through the gold sector just when everything else was going down, and in commodities and in emerging markets. So India started turning up, then Brazil turned up, and even China turned up. And so it was a very interesting time when you saw the rotation from the great growth machine into what someone would loosely describe as the value machine or the counter trend. So I became a gold bull, a rational bull. I'm always rational. I try to be rational. And then in 2012, a hippie friend of mine said, I just bought some ganja on the Silk Road in Bitcoin. And this Bitcoin thing's amazing. And he was a gold bug. And he said, well, it's got limited, Bitcoin's got limited supply. And I said, don't be stupid. You can't have money on the internet because you can cut and paste it.
Yeah, exactly.
The numbers. And so I just dismissed him. And then a year later, I went, oh my God, that was a mistake. And so I think Bitcoin had gone up 100 times between those two conversations. And I just sort of thought, wow. So I wanted to know what was under the bonnet. And you could really start to create a sort of price sales ratio, if you like, where you saw the amount of money flooding through the blockchain and the price of Bitcoin. And then you could do the number of coins and put them all together and get some sort of simple valuation metric. So it's measuring the market cap of Bitcoin, let's say, compared to the amount of traffic on the network. And that worked extremely well. It doesn't work anymore because Bitcoin's basically grown up so much that a lot of the traffic is off-chain. A lot of the stuff is on perpetual futures, or it's in ETFs, or it's in CME futures. this sort of thing. There's so many spin-offs.
I suppose the question there is whether Bitcoin risks, or is it already in a situation where I think true gold bugs would complain about the manipulated spot price of gold via these other mechanisms of owning gold. I don't know if you'd subscribe to that theory. I'm not sure I do, but they seem to be strongly held views by gold enthusiasts. Does Bitcoin have the same potential risks?
No, I don't subscribe to the views that, gold's financialization makes it a liquid asset. So there's $150 billion of gold changes hands each day, which is similar to the S&P 500. It's a vastly, massively, hugely liquid asset. Take away the financialization, okay, you and me and everyone else in gold land just sticks with bars and coins.
Yeah.
We've now got an illiquid market. It's like swapping art. The huge amount of value of Bitcoin and gold are the liquidity. It's really important. And so everything else in crypto is nothing like as liquid as Bitcoin, and everything else in commodities is nothing like as liquid as gold.
Were there moments on these big drawdowns where you thought, actually, you know what, I think I got this wrong?
So you're assuming that I've got a big pile of Bitcoin. And I think if I had a big pile of Bitcoin...
You probably wouldn't be talking to me now.
I'd be on an island somewhere. Yeah. So, knowing far too much about this sort of thing, I sold far too early.
Yeah.
But basically, my investment in Bitcoin is through Bold, which is the Bitcoin Bold combination, which is a gentle affair. There's no multi-millions.
The mistake most people make is they equate risk with volatility, whereas risk is really all about correlation. In 2001, when the tech bubble was bursting, or in 2008-9, when the world was bursting, everything correlates to one. You just want liquidity. So it's finding things that are less correlated and offer you protection in those very correlated markets.
Our Bold index is based on volatility, so I am going to refute that. Volatility is utterly useless in risk management out of context. You can't put a hedge fund with a long-short hedge fund volatility and take it that seriously. You can't take illiquid asset like real estate and pretend it has low volatility. You can't take private equity or other private markets where things are marked or have low liquidity. So, for example, an AIM stock, which sort of trades a lot and then it doesn't, and it trades a lot and then it doesn't.
Yes. Yeah.
Volatility in those situations doesn't really tell you much.
Well, that's sort of volatility laundering, isn't it, as Cliff Hassler calls it?
But when you go to proper liquid assets, it tends to be a very stable measure. Okay, so the volatility, the 10-year treasury, notwithstanding things like 2022, it's a pretty stable measure over 20 years. Gold's volatility is extremely stable over long periods of time, as are for proper companies like Nestle and Unilever. They persistently always have low volatility. So when you've got big liquid instruments that trade in the market all the time, it's a very, very powerful measure. But I think it's misused left, right, and center. So, for example, we look at the volatility of Bitcoin and gold to establish the weights in our Bold index. Gold is typically 17%, and we don't measure over 30 days like most people do, or even 90 days. We measure over 360 days. So you
do a rolling 360-day volatility.
Exactly.
Okay.
And what we're trying to establish by that number is the quality of the asset. So if Bitcoin is growing up as an asset, its volatility is coming down. And by the way, its liquidity will also be going up. There'll be more buyers and sellers each day in a lower volatile Bitcoin than in a high volatility Bitcoin over the course of a year, not obviously in panic moment. And the same is true for gold. Gold's volatility has been going up this year as it's finally getting more popular. Not by much. It's gone up a couple of points from sort of 15, 16 to 17, 18. And so the result is that our Bold index has gone from being 25% Bitcoin, 75% gold to 30% Bitcoin. The naysayers will say, would you think, boy, Bitcoin's going up, just own Bitcoin? Well, of course. But, my view would be, I don't know what's going to happen tomorrow. And therefore, what strategy we can have that aptly puts these together. Now, to your point on correlation, I wholeheartedly agree. Except, of course, when it all goes wrong, they do go to one. Just because everything's correlated doesn't mean that some things can't fall much further than others. For example, Nestle and Unilever in a crisis will go down a bit, whereas Rio Tinto and, oil and will go down a lot. And racy tech stocks will go down a lot. Portfolio construction is a very important point, as is position sizing. You've got to find things you like. There's no point buying something you think is shit. You have to buy things that you think are great, and then you mix them up a bit. I make no apologies to our clients that even though our portfolios have done well this year, we own a few things that haven't done very well. And it doesn't bother me at all because they're still attractive and they're still undervalued and they'll probably come around another time. For example, we've got one oil stock. Oil's, I'm not bullish on oil currently. I mean, long term, I know it's undervalued and all that sort of thing. But I'm more comfortable having an oil stock that could go up a lot than not having one.
Could you just give us an overview of what Bold is and what advantages that strategy has over owning either of the constituent parts?
Jeremy, that's the best question. And it's such an important one because Bitcoin and gold, go and own Bitcoin, tick, good idea. Go and own gold, tick, good idea. What proportion should you have? I've given you a volatility measure. It's free on our website, by the way, boldetf.com. You can go and look at the weights and follow them. So there's one extra bit, and there's a few reasons for this, but the most important one is the rebalancing. We rebalance the Bold index, which is calculated by a company in Sweden, and they do it at the end of the month. And so if Bitcoin should be 30% of the index, so it's had a good month, and so it closes the month at 38%, meaning that gold slipped from 70 to 62, let's say, for example, then we bring those back into line. That process of rebalancing is basically 30-35% portfolio turnover per year. And here's the good bit. Since the Bold ETF has been live real data, after fees, it's outperformed spot Bitcoin and gold by 7% per year.
When did it go live?
April 2022. Horrible time. Just as Sam Bankman fraud was about to come out. But we'd been waiting 2 years to launch it. It was a fight to get it launched. If you took the Bitcoin and gold weights at the beginning and never rebalanced them, where are you today? Versus going through the Bold journey with the desk in Zurich, the trading desk in Zurich, rebalancing every month. LBMA gold held by JP Morgan, real Bitcoin held by Copper, rebalancing the portfolio, selling the one that went up, buying the one that went down, and keep doing that. You've added, since launch, 21%.
You're not rebalancing because of price moves. You're rebalancing because of volatility moves. Is that right?
No. So there's two things. Good question. Let me clarify. The volatility dictates the monthly target weight, what we think the asset allocation should be.
Yeah.
Now, during the course of the month, markets do their thing. Trump speaks, rates move up and down, all the rest of it. Dollars fly around. The price of Bitcoin and gold will do whatever they do. And in a bad month for Bitcoin, we're buying at the end of the month back to target weight, and a good month, we're taking it down. Now, let's do that with French and German equities. Nothing, nada. Let's do it with equities and bonds. There's a little bit of outperformance historically, not in recent times, because they've been correlated. Back to correlation. Bad for bonds is bad for equities these days. It used to be the other way around. Not always, but, during the sort of golden era of the last generation. Let's do gold and silver. No added value whatsoever. Let's do Bitcoin and Ethereum. No added value whatsoever. Why do Bitcoin and gold have this extraordinary relationship? And that's really, really simple. And that's because they have extraordinarily low correlation. I'll illustrate that. 2013, gold collapses. Bitcoin, 100 to 1,000. 10x, yeah. When's the next interesting year for these things? So 2017, not a very interesting year for gold. Bitcoin roofs in. 2018, Bitcoin collapses, 80% or something. And gold starts its bull market. Again, restarts its bull market later that year. In 2020, we have the bull market top in gold. It stops in August 2020. And Bitcoin's just sort of rolling around at $10,000. Yes. And then as soon as gold starts going down, Bitcoin then goes up.
That sort of begs the old chestnut of correlation and causation.
Yeah.
And whether the correlation that you've discovered, the lack of correlation that you've discovered, has any causation to it and whether it's sustainable or not.
Absolutely. So correlations and causations and these are things that change. They're not forever permanent, even bonds and equities, as people have become used to.
Well, of course, yeah. The whole 60-40 portfolio, it's
built on the idea of something that wasn't permanent. I agree. So one day they'll become correlated, I'm sure. Gold is a risk-off asset, and bonds are a risk-off asset.
Correct.
Bonds like deflation, gold likes inflation. So we've got gold on the top, risk-off, bonds on the bottom, a risk-off. Low inflation. Now let's go on to the risk-on assets. Inflationary risk-on would be hard assets, commodities, heavy industry, and Bitcoin. And then we've got risk-on low inflation assets would be property, tech stocks, support services, all that kind of stuff. I've just got this very thing, we call it the ByteTree, we call it the money map. Most of our research is written around it.
Okay.
And we have these 4 quadrants: risk on, risk off, inflation up, inflation down. And if you believe there's an inflationary environment with lots of money printing, which there is, then gold and Bitcoin are the alternative asset equivalent to bonds and equities.
Right.
Does that answer your question?
I think so. There are moments where you find people criticize Bitcoin for being just a derivative of NASDAQ.
The correlation has always been high, but the gearing, if you like, the beta of Bitcoin to NASDAQ is probably 3. The 10% move in the NASDAQ probably means a 30% move in Bitcoin. It's something like that. Now, that is coming down. It probably was 10, 5 years ago. But yeah, the correlation, and it didn't used to be the FANGs. It used to be social media stocks, which makes complete sense because they are network effect companies. I'm not remotely surprised that internet money and internet stocks are correlated. By the way, the other group that sits in that top group are the banks. So, inflation risk on is very good environment for banks. Got high interest rates, and they've been flying this year.
Well, until it isn't.
Until it isn't.
Yeah.
Yeah, well, let's park that for the moment. But in that top box of risk on inflation is heavy industry, financials, and Bitcoin. And I would expect in the risk off moments for inflation-linked bonds to do better in an inflationary environment. Conventional bonds and high-quality stocks, Unilever, Nestle, in a low-inflation, risk-off environment. And then the most of the stock market to do well when you've got Goldilocks, low inflation and risk-on. So, I just, these 4 quadrants are how I diversify portfolios, back to your point earlier.
Yes.
They all have fundamentally different drivers. Now, they can all go down at the same time, but that's still not the point, because the point is the relative performance. So the stock market goes down 50%. If your bonds are flat, and your gold is down 5, and your quality stocks are down 20, and your racy stuff's down 80, what's the balance to make sure you have a reasonable outcome? If you panic about bear markets all the time, then you're not invested, you'll never make any money. So you have to be invested, but balanced around a true diversification framework. That's what we really do.
Okay. Presumably, you're in the UK, you've got UK customers, presumably. You've got this great idea to launch this product. You go to the FCA and you say, Mr. FCA, I've got this great collective product called Bold. We start trading Monday. Is that okay? They presumably didn't say yes.
So Bold is banned in the United Kingdom still because all crypto-related ETFs were banned in October 2020 on the same day that Ruffer announced they'd bought Bitcoin, which was...
Is that right?
Yeah.
I saw the latter. I wasn't aware of the former. Okay. What was their justification for that?
I mean, no one really knows, but the rumors we've heard is it came from the Treasury and not from the FCA. So they were told to do it. That's what we've heard.
Yeah.
No one's really owned this decision.
You had no chance of getting the Bold ETF sanctioned in the UK?
No. So elected professionals. So ByteTree clients are the best people in the world. I adore them. They've been crawling over hot coals to sign up as elected professionals and opening accounts in foreign countries. I mean, they're just amazing, some of them, the way they've got around some of these rules to buy it. I haven't shown them how to. I haven't asked them to or told them to. They've just got it done it. So they are a fabulous bunch. But a lot of them just can't. I mean, and you can buy it through Kilix or AJ Bell, but you have to sign up as an elected professional, which is something you've got to want to do it. You've got to either work in financial services or €500,000, ironically euros, not pounds. And the other one is demonstrate competence in trading. So if you can pass two of those 3 tests, you can do it, which applies to most active private investors, basically, if they want to. Yeah. But you do lose protections. And so, I think that people shouldn't really do that just so they can buy a Bitcoin ETF. You know what I mean? Enjoy the protections and wait for the system to change. And it is changing. So, the forecast is that the FCA has already announced it. So later this year, we're in a consultation period. Later this year, crypto ETFs are back in London. And please, the sooner the better, because crazy things are happening as a result of the ban.
You seem to use crypto and Bitcoin almost interchangeably.
When I say commodities, I mean everything but gold, and then I say gold. I say Bitcoin, and then I say crypto. So crypto is all the other stuff.
So in the Bitcoin vernacular, it's your word for shitcoin.
Yeah.
Okay.
And stable coins.
Stable coins are interesting. Yeah.
There's some good stuff in there. I mean, we shouldn't dismiss it all. How much of that if you want to, but,
No, happy to.
May I read a paragraph that I wrote yesterday?
Of course.
Because I'm doing a talk on stable coins in a couple of weeks.
Okay.
Okay, here we go. It's a short paragraph. Stablecoins were first launched in 2014 to counter the hefty banking restrictions placed on Bitcoin and crypto markets. They've grown into a $257 billion industry, with most tokens issued in US dollars. The stablecoin represents digital cash, which can be transferred around the world without a bank. Did I say that again?
Yes.
Without a bank. The issuer is incentivized as they pocket the interest, making it the most profitable and scalable business model ever known. Even governments are coming around to the idea as the issuers buy their bonds. The implications for banking, financial markets, trade settlement, and so on are mind-blowing.
And I think the IPO of Circle in the US, which has been phenomenal, I think that's about stablecoin. They're a stablecoin issuer, I think, aren't they?
They are indeed. But I think the market cap touched the amount of stablecoin they had at issue, which is an interesting one. But half the revenue goes to Coinbase. So, most of the smart hands say just own Coinbase if you want to have a shovel provider in the crypto space. Probably no better stock than Coinbase for that.
On the Bold ETF or the Bold Fund, is that something that you think in the fullness of time that is going to become a UK registered fund?
Well, I hope so. We're trying to launch it in London at the moment to get the listing ready for the ban to be lifted. I mean, it's based in Zurich, 21 shares of my partner. They're the company that run the product.
Okay.
$10 billion ETF company specializing in crypto. It's listed in France, Germany, Switzerland, and Sweden and the Netherlands. And so, London's on the list, and hopefully there's no point of being listed here now, but now the ban's being lifted, it's now a priority.
Okay. When you own these assets, gold and Bitcoin, in the fund, how do you own them, or and how do you custody these assets?
Jeremy, I hope by now you would know that I only want to launch this product if it was absolutely full-on institutional grade. So we have our gold with JP Morgan in LBMA gold in the London vaulting system. So it's exactly the same gold you'd have if you owned a gold ETF from iShares or whatever. And with our Bitcoin, we have it custodied with Copper and Coinbase. And Copper's probably the leading sort of well-known brand, but it's the leading crypto custodian. And so it's, cold storage and all that, high security and insured and these sorts of things. The delay to launching the product was, getting the whole market comfortable with giving us a proper gold custodian. And JP Morgan, bless them, came through. Took a long time, but HSBC, where I worked for 17 years, and I personally know the gold team, I know them well. Not so much these days, but certainly many of their former staff. And they said no. I mean, it was irrational because the gold's sitting in a different vault to the crypto, which is sitting in a...
They didn't want to be sullied with the idea of being...
Yeah. And so UBS...
I could be very rude about HSBC, but I probably shouldn't be.
But then, UBS didn't want to deal with our custody either. And they were the 3 bullion banks. And, me being pretty stubborn, wanted to deal with a bullion bank. And it's like, well, I want real gold. When I take this to an institution when they're allowed to buy it one day, I don't want them to say no because I don't like your custody. So I said, well, let's get the best possible custody arrangement. So any of those would have done, UBS, HSBC or JP Morgan. And when we got one, we launched.
Given where we've been to on this conversation so far, and we've briefly talked about the demise of the 60-40 portfolio, is there any place for bonds, government bonds, gilts, treasuries?
The most important thing is the index-linked bond yield, which is the one that pays you inflation plus the real yield. The real yields now on long-dated gilts are about 3%, which is as high as they've ever been. And you think, that's a really, really good investment return. If you buy this thing and then you get inflation, whatever happens, doesn't matter whether it's 0 or whether it's 10.
Do you believe the inflation rate, I suppose, is the question?
Yeah. So you take inflation out of the equation because you get rewarded for that.
Yeah, but which inflation rate?
Oh, the UK RPI.
But the rate of monetary debasement is a different kettle of fish.
Yeah, absolutely. So CPI and money supply are not the same thing. Money supply is growing at 7-8% per year globally, and inflation, how you measure it, of course, is more like 3 or something on average around the world. And yes, there's a difference. And I suppose in a more stable system, they'd be closer together. And that is probably why the bond market is just not well bid. And the interesting point will come when Trump gets his way and they slash interest rates. The Taylor rule, which those central bankers probably still respect, but no one talks about anymore, which is a model by central banks for where interest rates should be, would have US rates at about 6%, I believe. And in the UK, they'd be closer to 8%. So if you had interest rates at the Taylor rule, then your bond yield would be much closer to where the money supply.
Okay. Yes. Yes, makes sense.
So you could argue that interest rates are still too low, and CPI is understating inflation, as you say.
If Trump has his way and gets rid of Jay Powell and puts someone in place who slashes interest rates, and he's suggested a 1% policy rate, my view, if that happens, the yield curves would be forced down, but the term premium would just go off the clock, and you couldn't shift a 20-year bond for love nor money.
I think we'd see the steepest yield curve in history if we did that. I have no doubt that will see currencies go into competitive decline, particularly the dollar, if they're the ones doing it in isolation. And the thing to do would be buy Bitcoin, gold, commodities, and crypto. I mean, more so than anything else. And also heavy industry. We will have an overheating economy in that environment. Let's not forget that. It won't be a recession or a depression. It'll be an overheating economy. And so every factory will be at full capacity. Jim Ratcliffe with his chemical empire will be the richest man in the world. That sort of thing. Apart from Michael Saylor.
How does this world of real assets, hard money, fiat currencies, and burgeoning fiscal deficits and debt mountains end or resolve itself?
It takes a long time to destroy a successful country. Take our country, for example. You've got a public sector that's bloated, and you've got a private sector that's lean and dynamic. And let's not forget the contribution of the private sector, how they solve problems every day and get out there and do good things. And I'm not suggesting the public sector do bad things, but it is bloated and it's a high cost and it's a burden we can't...
It's inefficient.
It's inefficient. It's a burden we can't afford. And that is true in many, many developed countries now, in different versions of the same problem. What's happening at the moment is you've got 6% deficits in America. There's huge amounts of money. It's a couple of $1 trillion or so. And that is a form of money being printing. And so you take, what's the US normal GDP growth, inflation plus growth, it's a pretty high number approaching that money supply that we were talking about earlier. If you sort of do all these things like, the Wixell rule, Knut Wixell, the Swedish economist, late Swedish economist, who said the 10-year rate of interest should be, he didn't say that, but he comes to the conclusion that roughly speaking, the 10-year rate of interest should be about the same as normal GDP growth. Then actually...
Nominal or real?
Nominal.
Okay. Yeah.
And so if you sort of print the money and it sort of keeps appearing, you can sort of carry on for quite a long time. I mean, how long did Argentina do it? We were talking about your trip to Argentina recently. Yeah. It's a long time. And even when the monetary system's that's
part of 100 years or two, I would say, for Argentina to properly collapse.
Yeah. So we know it's not a good thing because Switzerland and Singapore are rich because they've got the best fiat currencies in the world. That's not a coincidence. And the countries that are poor have got, the worst currencies in the world. So, guess what? Cause and effect. Let's get back to that one.
Here's the thing. We were talking earlier about you should be long scarce assets and short abundant assets. So
bonds being abundant.
Bonds being very abundant, and becoming more abundant. And equities are there somewhere in the middle. And my recent bull argument for UK equities is there's not much scarcer at the moment than quality UK equities because all of them are being bid for and taken off the market. The good ones are buying themselves back with very aggressive share buybacks. And they're not issuing any new ones because the IPO market is effectively dead.
Yeah. It's a shame what's happened to UK equities and the position of the stock market. I'm told that, you'll know more about this than me because you're an AIM guy. I'm told that 20 years ago, it cost about $250,000 to be listed on AIM per year. What would you say to that today?
Oh, it's well over $1 million. I don't know. I'm not current, but it's well over $1 million. 25 years ago, when the US was wrapped up in Sarbanes-Oxley, AIM was the listing venues of choice for growth equities globally. I mean, It was an astonishing period of growth between whatever it was, 2000 and the GFC. AIM was just hugely successful, and it's now, a shadow of its former self.
Yeah. I mean, I really would like to see that market reinvigorated. I think it's a crucial part of our economic democracy, if you like. And the kids today, because they look at AIM and go in the stock market and they go, crikey, I don't own a suit, I don't understand the rules, and that's too expensive. So they go and do a crypto project instead, many of which are real businesses, by the way. So the whole thing has been, a cyberspace sort of regulatory arbitrage. And I think we shouldn't underestimate the importance of that. But also London suffers from paying stamp duty. It's one of the few stock markets in the world to do that. And it's just a sort of cumbersome place. I think it used to be more freewheeling. The fact that we banned crypto so aggressive in the last 10 years just tells you that the culture of our financial innovation and risk-taking appetite is wrong. Caveat emptor, if someone wants to buy Bitcoin, let them buy Bitcoin, and so on. And of course, you can still go to the casino or the racetrack and lose all your money. So it's a very inconsistent approach. Another area was equity research. You'll remember MiFID II with all the rules, and now no one can see research. Whereas when I started in the late 90s, private investors used to see notes from Merrill Lynch on internet stocks.
Yes,
and they flew around the world. So things have really, really clamped down, and it's not a good thing for the growth, because the best thing we can do is make new companies and leave the entrepreneurs to decide what they are.
It's all about taking risk, isn't it, ultimately? And you don't get the growth without taking the risk. And I think that somewhere along the line, our system, and it's easy just to blame the regulators, but the ecosystem, if you like, has bought into the idea that people should be protected from the riskiness. But of course, it's quite topical because in the last few months, the lower reaches of the UK stock market have discovered Bitcoin via this imitation of the Bitcoin treasury model.
It's a regulatory arbitrage, and I think it's nothing more than that. I know some people who, I hold in high regard in terms of their investment nous and understanding of markets and companies and how they work and that sort of thing, who like them, but I don't. I think that the premium by which the amount, if you take MicroStrategy, the big one, the market cap is twice the value of the Bitcoin in simple terms. Yeah. The rest of the business, so what? So you've got this very simple investment. The people who see it's an investment trust trading at a 100% premium. I'm in that camp. Then the other camp, the bull camp, say, they're doing all these tricks. They're issuing instruments, whether it's new stock or whether it's converts or whether it's preference shares or what have you. And they're buying Bitcoin at such a rate that they'll grow into their valuation. I just think that's hocus pocus, because the only thing that enables them to do those tricks is the premium. It all comes from the premium.
Of course it does, yes.
And take the premium away, it's gone. So why does the premium exist? Regulatory arbitrage. There's an army of Brits who want to own Bitcoin. They're not allowed to because of the rules, the ban, and so they buy MicroStrategy. And if you look at Hargreaves Lansdown top 10 traded stocks, week after week this year, MicroStrategy is on that list. It's always there. So I would think that a lot of the subscribers to MicroStrategy would be people living in countries where Bitcoin ETFs are banned. And those include, by the way, Japan, India, China, I believe, Singapore, UK, parts of the EU where they're shadow banned. So the rules have been interpreted differently in different countries, and so on. It's very difficult to buy a Bitcoin ETF. Now, in some European countries, they've made it easy, but in many, they've shadow banned. They've discouraged, and the wealth management industry has not engaged with the spec sector because it's seen as dirty. What happens in London will spread. So it's very important to remember that while the US might be the most important stock market in the world, London is the FX and the financial centre more generally outside of the UK stock market.
Much more international, yeah.
Yeah, and if the FCA unlock the ban here, that word will spread. Other countries will remove their bans and shadow bans. And I think that the demand for Bitcoin ETFs will just be much bigger than what we saw in the US last year. It will just continue, and we'll end up with Bitcoin being 2% of balanced portfolios in mainstream wealth management within 10 years.
The availability of regulated collective instruments to own Bitcoin and other crypto assets will suck out the premium from the treasury companies.
100%, that's what I think. And just as Grayscale Bitcoin Trust traded before US ETFs, the US used Grayscale, and even that went into a year before the ETFs were launched. That was at a 50 discount to NAV. So I think the MicroStrategy will go through a 100% premium to a 50% discount. And shareholders will lose 75% of their money relative to Bitcoin. That's what I think.
Just to counter that point, I owned MicroStrategy through the time that the ETFs were launched in the States, which was only January last year. And MicroStrategy did go to I'm not sure it went to a discount, but it certainly went to not much of a premium, if any premium at all, to the value of its Bitcoin it held on its balance sheet at that time.
Yeah.
I think most people thought that was it. That would be the basis of trading in the stock going forward. And then he being Saylor, discovered financial engineering and started issuing converts that gave him free fiat currency to buy more Bitcoin with. And I agree with you that there is definitely a regulatory arbitrage going on, but the premium didn't just go re-establish itself. It went off the clock, because at one point it was trading at 3 and a bit or 4 times the value of its Bitcoin on its balance sheet.
So that was driven by Brits and other people around the world who wanted to be in on it. And that's easy enough money. I'm just, as I say, that's the most popular stock.
If you look at the people that bought the converts, they were BlackRock, Vanguard, all the rest of them, Allianz. They're not retail investors. The converts, the prefs, they're owned by grade A institutional investors.
Yes, I think that's probably a slight exaggeration, grade A. I think that you might see BlackRock and stuff, they'll have a convertible fund.
Yes,
and it'll have a benchmark. And isn't MicroStrategy about 10% of the convertible benchmark now? Or something?
Probably. How else should investors think about capital preservation in this time?
Value equities. So that's what we do, what I do all day. And I love it. I mean, in the UK, it's fantastic right now. Europe's pretty good, but UK is even better. There's just so many good stocks that trade cheaply. I mean, we bought Glencore a month ago, and it's fabulous. On the AIM market, we own Jet2, with the market cap and the cash in the balance sheet are not dissimilar. The enterprise value is practically zero, and the company's got the operating statistics of Ryanair. There's some class out there in the UK market. So we do this balanced portfolio called Soda. The benchmarks are 60-40, but we don't own the 40. We just own other ways of taking low risk. And then we have a whiskey portfolio. It's a whiskey and soda. And that's basically equities, which is mainly UK at the moment. But we do Europe, ETFs elsewhere, gold, that sort of thing. And we just buy single stocks and diversify them. Some of our stocks are growth stocks. Some of them are traditional value. Some of them are financials. Some of the natural resources. But everything's carefully picked with a sniper rifle. So we do our job. And then I've got another service called Venture, which is mid and small cap. Same thing, just deep value.
UK or global?
Only UK and Europe. I mean, we've got a bit of Canada and America, but I just get it in UK and Europe more so than I do in America. I understand American stocks and how they work and all the rest of it, but lots of the ratios I use don't work in America. For example, book value and then revalue assets and things. And it's just some of the ways I look for value aren't as obvious. A really good example is the REIT market. Real estate in America is currently quite troubled, whereas in Europe and UK it's really picking up nicely. They just maxed out their businesses and tried to screw the last dime out of every tenant, and everyone's really pissed off now. And now you've got probably a downturn in the sector in America, and you've probably got an upturn here. So, you didn't ask me for your hotspot for a crisis, but US real estate would be my red flag.
And a lot of US companies, of course, they're issuing a lot of equity share-based compensation, coming back to this abundance and scarcity point, whereas one of the features of the UK market, although we beat ourselves up because we seem to see monthly outflows constantly, but actually that's against a backdrop of the UK PLC is sort of buying itself as well. I mean, these share buybacks and takeovers is making our equity scarcer. Yes,
you're absolutely right. And the makeup of the market is slightly uncomfortable. It's heavily energy, mining and banks.
Yes.
Sort of part of the FTSE, pretty much. But the other half's really interesting. If you sort of knock out the top 10 stocks of the FTSE and see the rest of it, it's amazing. I did an exercise on this. If you sort of knock out the sort of sectors you shouldn't really own long term, I'm bullish on natural resources at the moment, but any long-term investor know that's not a compounding machine like proper companies are. So if you knock out all those sorts of things and the financials, and then just look at the next 30 stocks, and so you knock out all those sort of asset-heavy industries, and then suddenly the thing looks amazing. It's just a whole bunch of dynamic, fast-growing, wonderful companies. So I love the stomping ground of our market at the moment. And it's not always like this. There have been years when it's been terrible and we've had to go elsewhere. But I've no doubt that the US is at some kind of major peak in relative terms, dollars coming down, and the rest of the world's the opportunity. So you want to be owning Europe and UK and Japan and emerging markets. And I think if you're a passive investor, just do that. I think you'll be fine alongside some gold, Bitcoin, commodities. But more specifically, pick stocks, and there are plenty of within that universe.
Charlie, it's been a great conversation. I've taken up enough of your time. Thank you so much. Good luck with everything. Good luck with bringing your Bitcoin and gold strategy directly to the UK. I hope it all works out. It's been a fascinating conversation, and hopefully we can have a catch up soon, maybe when MicroStrategy is trading at half the value of the Bitcoin on its balance sheet. Might be a suitable time to have another conversation, but maybe before then, who knows?
Thank you. Thank you for the excellent questions.
Brought to you by Progressive Equity.